Welcome back to Talk Tickers. This is the deep dive where we strip away the noise and get straight into the numbers that are actually moving the market.
And today we are talking about the main event, the one everyone was holding their breath for.
Oh, the big one, Meta Platforms. Q4 2025 and, the full look at the year ahead.
Exactly. And it really felt like the entire market was just poised on a knife edge, waiting for this print.
It did. I mean, you look at the context this week, the whole Magnificent Seven trade has been a little shaky.
A little bit, yeah.
There's been this underlying anxiety. Everyone's asking the same question. Is all this massive capital expenditure, all these billions being poured into AI, is it actually going to turn into profit?
Or are they just lighting cash on fire in some kind of tech arms race? That was exactly the mood. We call it the CapEx jitters.
Right. And Meta was, it was the bellwether for the entire industry this quarter.
Absolutely. If they faltered, if they showed they were spending heavily with nothing to show for it, the whole AI trade could have wobbled. Investors were ready to hit sell.
But they didn't wobble. In fact, they flexed.
They flexed hard.
The market has spoken, and loudly. We watched the stock in after-hours trading, and it rallied, approximately 11%?
Yeah, it went from a close of around $668 to over $742.
And you have to remember, for a company with a market cap of this size, to move the needle that violently in a few hours is almost unheard of.
It's a massive vote of confidence. The market looked at the numbers, including some, very scary spending numbers, which we will get to.
Oh, yeah.
And they decided, we don't care about the cost, we are buying the growth story.
So that is our mission for this deep dive. We need to unpack why that happened. We're going to hit the headline beat, look at this massive 2026 infrastructure guide.
And we have to dissect this new pivot to what Mark Zuckerberg is calling personal superintelligence.
Which sounds like something straight out of a sci-fi novel.
It does, but it's actually the core business strategy now.
Right. And of course, stick around for the end, because we have a very interesting, maybe slightly outrageous, not financial advice, trade idea based on what we found. But let's start with a snapshot. The headline numbers.
It was a beat across the board. You look at the bottom line. First, GAAP earnings per share came in at $8.88.
And the consensus on the street was only $8.21.
Exactly. So that's an 8% beat on profitability. That is not a rounding error.
No, that's significant.
It is. But the top line was just as healthy. Revenue clocked in at $59.89 billion for the quarter.
Okay, up 24% year over year.
Yeah.
I want to pause on that for a second, because I think people get a little desensitized to these numbers. Growing 24% when you're a small startup is one thing. Growing 24% when you're already at nearly $60 billion in a single quarter. The law of large numbers usually makes that impossible.
It's immense. They beat the street estimates by nearly $1.4 billion. This is a company of massive scale, growing like a much smaller, hungrier tech stock.
And because of that scale, the margins
stood strong. Operating margin was at 41%.
That's the cash cow signal right there.
It's precisely that. When you have 24% revenue growth combined with 40+% operating margins, it just gives you so much permission.
Permission to spend.
It gives management the license to spend heavily on the future because the core business is just printing so much money right now.
And the engine for all that cash is unsurprisingly, the user base. I was looking at the DAP family daily active people. It hit 3.58 billion.
Up 7% year over year.
Just think about that. 3.58 billion people. That is almost half the planet checking a Meta app, Facebook, Instagram, WhatsApp, every single day.
And they aren't just checking in, they're being monetized more effectively. This was a key metric for me in the report.
Which one?
Ad impressions increased 18%, which shows engagement is high, particularly with video and reels. But, and get this, the average price per ad increased 6%.
Okay, that's the quality metric for me. Because usually in ad tech, when you increase impressions that much, when you flood the zone with new inventory,
the price drops. Supply and demand.
Exactly.
Yeah.
But that didn't happen here.
No, it didn't. Demand is robust. Advertisers are willing to pay more even as supply increases, which tells you the ad performance, the conversion rate is working.
Which just explains the market reaction. Volume on the stock spiked, 93% compared to the prior day?
Yeah.
Investors saw these core fundamentals, this ad engine, and decided it is strong enough to fund the AI war.
And that is the perfect segue, because the AI war is where the strategy really, really shifts in this report.
This is where it gets fascinating.
It does.
Mark Zuckerberg didn't just come out and say, we're building AI. He used a very specific phrase. He framed 2026 as the year of personal superintelligence.
This was the thematic core of the entire call. He's moving the goalposts. For the last couple of years, the buzzword in Silicon Valley was AGI, artificial general intelligence.
Building a godlike computer brain, basically.
Right. Now, Zuckerberg is pivoting to building AI that understands personal context.
Okay, so what does that distinction mean practically for someone listening?
It means moving from an AI that knows facts, like who won the 1998 World Cup, to an AI that knows you.
Your history, your interests.
Your relationships, your calendar, everything. Zuckerberg mentioned that current recommendation systems, even the ones making them $60 billion a quarter, are primitive compared to what's coming.
Calling a $60 billion engine primitive is a massive flex.
It's a huge flex. But he's talking about merging large language models directly with the recommendation engine.
So instead of an algorithm just guessing what you might click on.
Right, based on a pattern, you have an AI that understands the semantic meaning of what you're looking at and how it relates to your specific life.
It's the difference between a salesman who memorized a script and a salesman who's known you for 10 years and knows exactly what you need.
Perfectly put. But here is the kicker. To make that personal superintelligence useful, it can't just live on a server farm somewhere.
It has to be with you. It has to see what you see.
Exactly. And this is where the hardware narrative gets really interesting.
The glasses.
The glass.
Zuckerberg compared the current state of smart glasses to flip phones right before smartphones took over. And I love that analogy.
It's a great one.
Because we all remember the flip phone era. It was fine. It made calls. But then the smartphone came out, and suddenly the form factor changed everything.
And he thinks we are at that exact precipice with eyewear. He noted that sales of Meta glasses tripled last year. Tripled. He is predicting a near future where most eyewear is AI-enabled.
And the logic is incredibly sound, right? If you need vision correction anyway, which billions of people do.
Billions?
Why wouldn't you want a supercomputer on your face if the frames look normal?
If the price is comparable and the style is, Ray-Ban, it becomes a no-brainer. You get the vision correction, plus you get an assistant whispering in your ear.
Exactly. And for investors, this completely changes the whole narrative around Reality Labs.
It does. We spent years talking about the metaverse money pit. Reality Labs losing billions every single quarter, just dragging down the stock.
It's been the black mark on the balance sheet forever. People hated it.
But they noted on this call that Reality Labs losses are expected to peak in 2026.
And that right there is a critical signal.
It tells us there is a light at the end of the tunnel. If glasses sales are tripling and they're finding a form factor that normal people actually want to wear,
that money pit starts looking less like a waste.
And more like a strategic moat. They're building the next hardware platform.
And speaking of accessibility, they are finally moving Horizon, their virtual world, to mobile.
Which is a smart move.
Trying to get people to put on a big clunky headset to hang out in a virtual cartoon world was always a high-friction ask.
Yeah, a huge ask.
But putting it on the phone everyone already has.
Yeah.
That lowers the barrier to entry significantly.
It's about meeting users where they are. Oh, and briefly, did you catch the note on the Manus acquisition during the Q&A?
I did. It seemed like a smaller note tucked away.
It was, but they intend to use it to bolster business subscription tools.
Which shows they're thinking about monetizing this AI beyond just ads. They want to move into, like, SaaS subscriptions for businesses.
AI agents that handle customer service, sales, logistics, a whole new revenue stream.
Okay, so the vision is there. Personal superintelligence, smart glasses, business AI. But visions are expensive.
Very expensive.
And we have to address the elephant in the room. The number that usually sends investors running for the hills.
The CapEx shock.
The capital expenditure guidance for 2026. Break it down for us.
All right. They are guiding for $115 billion to $135 billion in CapEx for 2026.
$135 billion. I mean, just to put that in perspective, that's more than the GDP of many countries.
It's a staggering amount of money to spend on infrastructure in a single year. And total expenses are projected at $162 to $169 billion.
It is a massive step up. It's tied to building more data centers, buying mountains of silicon,
securing energy contracts, and funding what they are calling superintelligence labs.
The superintelligence labs just sounds expensive.
It does. But here is the bull case. This is the why. Why did the stock rally 11% instead of crashing 20%?
Right, because usually a company says, we're doubling our spending, and the market freaks out. So why didn't they?
It comes down to one person, really. The CFO, Susan Lee, she clarified a crucial point that saved the entire narrative.
Oh, yeah.
She said that despite this massive infrastructure ramp, 2026 operating income is expected to be above 2025 levels.
That's the magic formula.
It is. It implies that the core business, the ads on Instagram and Facebook, is growing so fast it can absorb $135 billion spend and still grow profits in absolute dollars.
So they aren't burning cash they don't have, they're reinvesting the windfall?
Exactly. They're funding the war with their own cash flow. And speaking of cash flow, did you notice the capital allocation strategy?
I did. No share buybacks in Q4. 0.
Which is a huge signal. Usually investors love buybacks. They prop up the stock price.
Of course.
But here Meta is saying, we have a better use for this cash than retiring shares. We are going to buy silicon. We are going to buy energy.
They are funneling every spare dollar into the AI war chest.
And they have to. Management admitted they are capacity constrained.
Which means they want to do more than they currently can.
Right. They said internal demand for compute is outpacing supply. They aren't building these things hoping users will eventually show up.
They're building them because their own engineers and systems are screaming for more compute right now.
The demand is real, but let's look under the hood at why they need that compute, because it's not just for chatbots.
No, this is the engine room. Ad tech.
Right. They talked about moving to the GEM model and lattice architecture.
A lot of fancy names there.
Fancy names, but with serious results. They doubled the GPUs used for training ad ranking.
And for the non-technical listener, this isn't just tech for tech's sake.
No, this drove a 3.5% lift in ad clicks on Facebook and a 1% conversion gain on Instagram.
In the ad world, a 3.5% lift in clicks across billions of users is basically like printing money.
It is pure efficiency. The AI is just getting better at putting the right product in front of the right person at the right moment.
But there was another efficiency stat that really blew my mind.
Yeah.
I think this is the sleeper hit of the whole call.
The agentic coding.
Yes.
Oh, this is fascinating for anyone watching margins or anyone working in software, honestly. This is the future of work.
They said agentic coding adoption has driven a 30% increase in output per engineer.
But the power users of these tools,
Their output jumped 80%.
80%. Imagine if you could get almost double the work out of your highest paid employees.
It completely changes the economics of a tech company. It suggests Meta can scale new products like the metaverse, like these AI agents, without just linearly scaling headcount.
You don't need to hire 10,000 new engineers to do 10,000 engineers worth of work anymore.
It validates that the whole year of efficiency wasn't a one-off. It's becoming structural.
It is. If one engineer can do the work of two, the operating leverage in the model over the next 5 years is just, it's incredible. Revenue can go up while headcount stays flat.
Expanding margins even further. Okay, so we have a great quarter, huge spend, but it's covered by huge revenue. Efficient engine. What are the headwinds?
Right.
Can't just paint a rosy picture. What could go wrong?
Well, the guidance for Q1 2026 revenue is $53.5 billion to $56.5 billion. That assumes a 4% FX tailwind, which helps.
But it's not all smooth sailing. Regulatory risk is always that dark cloud hovering over them.
Always. And it's real. The EU less personalized ads change is rolling out this quarter. That is a direct headwind to pricing power in Europe.
If you can't personalize the ad, you can't charge as much for it. Simple.
And here in the US,
What's on the docket?
they flagged US youth-related trials scheduled for this year. And they explicitly said this could result in a material loss.
Material loss is just lawyer speak for this is going to be incredibly expensive.
Very expensive. But it seems the market, at least for now, decided the growth outweighs the legal threats. The market is forward-looking, They are looking at the transactional story. This wasn't an earnings call about M&A or legal battles. It was about capital allocation. Management is asking investors to underwrite a heavier fixed cost base now.
For a larger AI-enabled profit pool later.
Exactly. And the sentiment shift is palpable. The fundamentals first message landed, remember a few years ago, the debate was, can they monetize Reels?
Is TikTok killing them?
That debate is dead. They prove they can monetize with plus 24% revenue. TikTok didn't kill them.
So the debate now is entirely about the ROI on this next compute cycle.
Can they turn $135 billion in CapEx into $200 billion in new value? And given their track record, with mobile, with stories, with Reels.
The market is giving them the benefit of the doubt. It really feels like they have successfully pivoted the narrative from social media company to AI infrastructure and product company.
They have. And here's the kicker. Because they own the distribution, those 3.58 billion people, they are the only ones who can deploy these personal superintelligence features instantly to half the planet.
That is a devastating advantage against a startup. You can have great tech, but if you have 0 users, Meta wins.
Distribution is king.
Okay, we've crunched the numbers, we've analyzed the strategy. Now it's time for the segment everyone waits for. This is not financial advice segment.
Disclaimer time. We are just 2 voices on a deep dive. Do your own research. Please do not trade based on what we say. We are just having fun with the data.
Exactly. We are looking for the outrageous but plausible. So based on this call, if you had to pitch a wild trade idea, what is it?
I've been thinking about this. I'm calling this one the silicon and spectacles pair trade.
The silicon and spectacles. I like the name. Break it down.
Okay. Leg 1 is long energy and silicon. It's simple logic. Management explicitly stated they are capacity constrained.
Right.
They said internal demand is outstripping supply. They are building superintelligence labs and spending up to $135 billion.
So you don't short the shovel sellers when the biggest miner just doubled their budget.
Exactly. You buy the companies making the shovels, the silicon, and the companies powering the energy. Nuclear energy plays specifically.
Follow the money. Okay, makes sense. What's leg 2?
Leg 2 is short human-scale dev shops.
Ooh, this is spicy.
It's based on that stat we talked about. Internal engineering output is up 30 to 80% due to AI agents.
The efficiency gains.
Right. If one engineer can now do the work of 2, the billing models of traditional software consultancies are about to break.
You mean the firms that bill by the hour for coding work?
Precisely. If AI writes the code faster, their billable hours just collapse. Or their clients, like Meta, realize they don't need to hire external firms because their internal teams are 80% more productive.
The body shop model of software development is in the crosshairs.
I think so. It's a fascinating take. Long the tech, short the labor arbitrage.
But you mentioned spectacles in the name. What's the twist?
The outrageous twist is betting that the flip phone to smartphone moment for glasses is actually real. The trade isn't just buying Meta stock. It's looking for the supply chain partners specifically making the frames and the lenses, not just the chips.
Why frames?
Because if billions of people strictly need vision correction and they want AI, the form factor winner takes all. If Ray-Ban or EssilorLuxottica, who is the partner here, becomes the default housing for the world's AI.
That is a consumer staple play disguised as tech.
It's betting that in 2030, we aren't looking at our phones. We are looking through our phones.
And if you look at the sales tripling this year, maybe it's not as wild as it sounds.
It's the plausible part of outrageous but plausible.
I love it. All right, let's wrap this up. Meta delivered a massive beat and raise quarter, revenue up 24%, huge engagement, and a confident, albeit expensive pivot to personal superintelligence.
And the market rewarded the clarity. Higher spend is okay as long as operating income keeps growing. Susan Lai gave investors the safety blanket they needed.
And Mark gave them the vision to believe it's going somewhere exciting.
A smartphone moment for your face. It's going to be an interesting year.
Indeed it will. That's it for this deep dive into the Meta Q4 2025 print. Thanks for listening. And remember, do your own research. We'll see you on the next print.